In 2021, ProPublica obtained a secret cache of IRS tax records. Inside those files was a number that should have made headlines for years. The 25 richest people in America, people whose combined wealth grew by over $400 billion in a single year, paid an average federal tax rate of 3.4%. The average American school teacher paid more proportionally than all of that. And here is the part that will bother you the most. None of it was illegal. Not a single crime was committed. This is not a loophole. This is not a gray area. This is the system working exactly as it was designed. And it has a name. Buy, borrow, die. Welcome to Wealth Protocol. Why do billionaires pay so little? Before we get into the strategy, let's make sure we understand why this is so strange. Most people pay income tax. You earn money, the government takes a percentage. Simple. But here's the thing. Billionaires, for the most part, do not earn money in the traditional sense. They don't receive a salary. They don't get a paycheck. Their wealth lives inside company stock. And stock, until the moment you sell it, is not income. In the eyes of the IRS, an unrealized gain is not a taxable event. Let's look at a real example. In 2018, Elon Musk paid no federal income tax. In 2014, Jeff Bezos also paid zero. Michael Bloomberg, worth $55 billion, paid income taxes on a reported income of less than $2 million in 2018, a rate of less than 1%. These are not estimates. These are the numbers from the secret IRS files. So the question becomes, how do they live? How do they spend? If they are not selling stock and they are not earning a salary, how does a billionaire pay for a 500 million yacht? The answer is the buy, borrow, die strategy. And understanding it will permanently change how you think about money. Step 1. Buy. The strategy begins with a single verb. Buy. Not buy cars, not buy mansions, buy assets. Specifically, buy assets that appreciate in value. Stocks, real estate, private equity stakes, art, businesses. Here's the fundamental insight. The rich don't get rich by earning more money. They get rich by owning things that become more valuable over time. Warren Buffett has said this clearly. He's never sold a share of Berkshire Hathaway. His company is worth $900 billion. He has been its largest shareholder for 50 years. And because he never sells, he has never triggered a capital gains event. No sale, no tax. Now you might say, fine, but what about capital gains tax? Don't they pay that when they sell? Yes, but the buy, borrow, die strategy is specifically designed so they never have to sell. That's where the second step comes in. Step 2. Borrow. If you want to spend money without selling your assets, You borrow against them. This is the second step, and it is arguably the most elegant piece of the entire system. Here's how it works in practice. Imagine you own $1 billion worth of stock in a company you founded. You need $100 million to buy a private island, fund a rocket company, or simply live. You don't sell the stock. Instead, you walk into a bank, or more precisely, your private wealth manager does it for you. You pledge your stock as a collateral. The bank gives you a loan, $100 million in cash. The interest rate? Somewhere between 1% and 3% per year, for lower than the 20% capital gains tax you would have paid if you'd sold. Now here's the key question. Is a loan taxable income? No, it's not. A loan is not income. The IRS does not consider borrowed money to be taxable. You now have $100 million in your pocket, and you've paid zero income tax, zero capital gains tax, and your stock continues to grow in value. This is not hypothetical. This is documented. In 2021, Bloomberg News reported that Elon Musk pledged over $57 billion of his Tesla shares as loan collateral. Larry Ellison, founder of Oracle, used this strategy to avoid selling stock while funding a lavish lifestyle that included a 288-foot yacht and a Hawaiian island. Larry Page, Sergey Brin, Mark Zuckerberg. This strategy is standard practice inside the world's wealthiest families. But wait, what about the loan? Eventually, you have to pay it back, right? Yes, but again, how you pay it back is the entire strategy. You do not pay it back by selling stock. You take out a new loan to pay the old one. As long as your assets keep growing faster than the interest rate on your loan, which for well-diversified assets, they historically do, you can roll this forward indefinitely. And here is where the third and final step turns this from clever to virtually immortal. Step 3. Die. The third step is the one that closes the loop entirely, and it requires nothing more than time. When a billionaire dies, their estate passes to their heirs. Normally, you might assume those heirs would owe capital gains tax on all the stock they inherited, all the gains that were never taxed during the billionaire's lifetime. Gains accumulated over 30, 40, even 50 years of compound growth. Gains that, in some cases, represent hundreds of billions of dollars of untaxed appreciation. But here's the provision in the US Tax Code, Section 1014, known as the stepped-up basis. When assets pass to heirs upon death, the cost basis, the original price that was paid for them, is stepped up to the current market value. In plain English, the entire gain that accumulated during the billionaire's lifetime simply disappears. It is legally erased. If the heirs then sell the inherited stock at market value, they pay zero capital gains tax, because in the eyes of the law. Their cost basis is today's price, not the price it was bought at 50 years ago. The loan? It gets paid off using inherited assets. And the tax bill that should have come due over 50 years? Gone. This is buy, borrow, die. Not a loophole, not an accident, a feature. Now you understand the mechanics. But I want to go one level deeper. Because the question isn't just how this works. The question is, why does it exist? The stepped-up basis provision has been in US tax law since 1921. There have been many attempts to reform it. All have failed. Why? Because the people who benefit from it are the same people who fund political campaigns, employ lobbyists, and sit on the boards of think tanks that advise policymakers on tax legislation. This is not a conspiracy theory. It is the documented mechanics of institutional power. In 2021, the Biden administration proposed eliminating the stepped-up basis as part of the American Families Plan. It died in committee. In 2022, a proposal for a billionaire minimum income tax was introduced. It never passed. The system does not persist because people are not paying attention. It persists because the people who benefit from it have far more influence over the system than those who don't. This is the wealth protocol. Not just buy, borrow, die, but build the system, fund the rules, ensure the rules stay. Now, can you use this? What it means for you? Before we close, I want to answer the question you are probably asking. Can you use any of this? Honestly, yes, in principle. The math is available to anyone who owns appreciating assets. If you own a home that has grown in value, you can take out a home quality line of credit, a loan secured by your home, and access that cash without selling and paying capital gains. If you own a portfolio of stocks, some brokerage accounts allows margin loans using your holdings as collateral. These are real tools, not just for billionaires. The scale is obviously different. Billionaires borrow at 1.5%. Most people borrow at 7 or 8%. But the underlying logic, own assets, borrow against them, let the assets keep growing, is accessible at every level. The real takeaway isn't just the tax strategy, it's the underlying principle. The wealthy do not get rich through income. They get rich through ownership. The protocol isn't buy more things. The protocol is own more of what appreciates. The 25 richest people in America made 3.4% in taxes on $400 billion of wealth growth. And they did it using a system that has been sitting inside the US tax code for over a century. A system with a name. A system that is documented, legal, and almost entirely invisible to the people who pay for it. This is Wealth Protocol. We are going to keep pulling back the curtain. Next time, the invisible market worth $10 trillion that the Federal Reserve doesn't control, and that most economists will never mention on camera. If this changed how you see the system, subscribe. There is a lot more protocol to uncover.